welcome to Mint. I'm Rajita Saxena and joining me today on the show from the newsroom is Deepti Chaudhary. Deepti, welcome to the show. In today's show, we'll be discussing how private equity firms are increasingly favoring debt financing over equity investments in the real estate sector. To understand why, let's speak to Deepti. So Deepti, please tell us what's really attracting private equity firms to debt financing in the real estate sector.
So real estate, has been a hot sector for private equity investors since 2006 onwards. But if you look at the exits that they have made, it's not really encouraging. Right now, banks are also shying away from investing in real estate developers. So what has happened is, because private equity investors have not been able to generate capital, they feel that doing debt or debt-like structuring of deals is going to at least offer them assured returns. Assured returns are anyway better than no returns. So that is one of the reasons that they are looking at debt or debt-like structures in their deals, even if they are doing equity deals. Otherwise, they are going for pure play debt investments.
So to understand it better, how are private equity firms actually hedging their risks involved in this process?
Debt deals are not risk-free. So these companies, the private equity investors, are taking various steps. For example, they ask for collaterals, they ask for control over construction, they ask for control over projects. They want to be the first one out when sales of the apartments in case of residential projects happen. And they are very clearly seeking escrow accounts. So what happens is, whenever some money comes in, the money goes into that escrow account, and from there it goes directly to the private equity investor.
So looking at the steps that private equity firms are taking, going forward, what is the outlook in this space? How many deals or what kind of deal flow can we expect in this space?
2012 saw about 50 deals in real estate, and experts say about 80% of the deals that are happening right now are going to have a huge debt instrument involved. The assumptions are that about 50-55 real estate deals will happen in 2013, and debt is going to be the majority part of these deals. It's not going to be too much of equity.
So thanks a lot, Deepti, for taking us through that story. To understand more about how the private equity firms are increasingly looking at debt financing in the real estate sector, please log on to www.livemint.com.